Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking another look at Birkenstock Holding PLC, ticker BIRK. This is a stock that we took a look at right after they IPO'd, found that they IPO'd at a very good price and they were on the buy list for a while, ran up into the 60s, kind of became overvalued and got onto the sell list, and then they had some earnings. So we're going to take a look at how those earnings were and if they're back to a reasonable point. With these most recent earnings coming up with a fair value just shy of $46. Pretty good, currently sitting at a price of 54, just kind of cash flows 55. They were as high as 62, as low as 36 in the last 52 weeks. Earnings yield pretty low. We'd be wanting $2.72 in earnings per share for the value that we're paying, and this year they're expected to come in at 138, next year 188, so that might be another 3 to 5 years out, honestly. Cash flow yield is very strong, 16.55, on average 16.12, so they're holding up in that double-digit range. Cash flow is one of the most important things for a stock, and they definitely have money that they can use to invest and grow their business. Dividend is non-existent on this one. They are really new to the market. ROE, ROI, and ROA are all pretty low on this one, though. And debt to equity, right about the line. Anything above 1, we don't really like to see. We like to see this as low as possible, but they're not getting great returns on their equity, their investments, or their assets. Gross margins, very strong, almost 61%, usually around 60. Net, 6%, usually 9.6. So there was a smaller net margin over this last year than we've seen previously, but definitely gives them room to bounce back. And it doesn't look like there's anything too crazy that would show continuation of that. Now we build our thesis. So we're looking for some expectations for revenues, share count, cash flows, assets, liabilities, dividends, and margins. Analysts are projecting about 18 to 19% growth over the next 2 years in the revenue, so we'll go along with them. 18%. Share count has not changed since they IPO'd, so it'd be nice if they can hold it at this point up until the point where they decide that they can start buying back shares. Cash flows, they've had some pretty good growth previously. We want to see it grow in line with the revenues, but I feel like we can be pretty reasonable here. They already have a very high cash flow yield. 16% would take it down to 15.2 over the next 5 years. So maybe if we do 17, just 1% below the revenues, or back down to that 16 mark. Assets, low growth, bigger in the last 2 years than the last year, but 2% seems to be a pretty fair estimate here. And then liabilities, 1.5% seems to be pretty good there as well. They do not yet pay a dividend. It'd be nice if they did. And the margins, we'd like to see them get back up to 9.5%, ideally even 10%. So a 10% growth annually will get them there in the next 5 years. So if you purchase at today's price, $54.30, then you're probably looking at breaking even, if not losing out a little bit in the next 3 years. And over the next 5 years, you're going to underperform the market by almost half. So clearly it's in a spot right now where its price is elevated for sure. You are looking at annual returns of 16.8% though, so a great growth stock. Of course, that's what we'd expect from the high revenues and really good margins here. But personally, I definitely would wait until the mid to lower 40s to get into this. I mean, if you go with the fair value $46, you're in line with the markets in the next 5 years. So if you can get into it lower than that, closer to 40 itself, you're outperforming in the 3 and the 5 years. So my price target on this would definitely be $40. And now we can see what a worst case scenario would be here. I feel like reasonable is kind of best case. You can see all of these high. I wouldn't really change the revenue, maybe 1%. Share count, I wouldn't really change, but let's go with a worst case scenario and see if 40 would still be reasonable at that point. The lowest growth that we've seen out of them is 9.4%, 9.5. So we'll go with 9.5. For the revenue share count, even if they start issuing, I don't think they'd issue a whole lot. So we'll go with something small there. Cash flow growth, negative 3.5%. That's the lowest that we've seen out of them. Assets, 0.75. Liabilities, this we would want to take the higher number on, 3.25. No dividend, and the margin, if they continue to decline on their margin, I don't think it'd be anything too large. 1% decline year over year would take them down just shy of 6%. So in this case, purchasing at today's price, you're definitely underwater in the 3-year, almost losing out as much as the market would have gained in that time frame. In the 5 years, you're now losing out as well, with only an expected return of 8%. So returns in line with the markets, but you're getting in at a very, very elevated price. That's why we work in a margin of safety, just in case we're incorrect on our numbers. Because even in this scenario, if you can buy with a margin of safety down in the 30s, you are significantly outperforming the market in the 3-year and in the 5-year. It's been as low as 36 in the last year, and given the worst case scenario, that is just under market returns, but at least it's not negative. So we can take a quick look at the valuations charted out and see how everything's moving. So we'll start with this red one down here. This is the earnings. They took a pullback in 2022, and based on what analysts are projecting, they're off to the races, going from the lowest valuation to one of the higher ones. And then we have the actual fair value of the stock, which seems to move pretty well in line with those earnings. And if the earnings are on an uptrend, I'd expect the stock price to do so as well. Cash flows seem to be pretty flat. I mean, they have that high yield. I don't see them getting a whole lot higher than that, so that's not really a surprise here. The purple here is the balance sheet. Again, that's pretty flat. Dividend is non-existent, and the actual share price is way up here. So clearly elevated price currently. Really based on the averages, it has been for quite some time. But some people were able to get in at the 30s. I bought most of my position around the $40 level, and then I sold out in the 60s. I was up 50%. So that was my take profit area on this one, because I wasn't too sure what was going to go on with it being so new to the market. And it's pulling back right now. I definitely am waiting to see if it gets back into those 40s and would not hesitate to buy if it did so. But that's what we're looking at on this one. Nothing too crazy here. I'm not huge on trading stocks, but it ran up so much so fast that I wanted to lock in those profits because it had gone above what I was expecting out of it. And I didn't want to be holding on to it when it pulled back down to a more reasonable level, which it looks like it's in the process of at the moment. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.